Welcome back to the channel. Today's video is for anyone who cares about passive income, long-term investing, and building a portfolio that can actually survive real-world market cycles. Whether you're already retired, thinking about retirement, or just trying to create an income stream that doesn't depend on your job, this discussion is extremely important. Right now, many investors are feeling confused and even frustrated. The stock market seems to be racing higher, driven mostly by technology stocks, while some of the most popular dividend ETFs appear to be going nowhere. You open your brokerage account, you look at the numbers, and you start asking yourself an uncomfortable question. One ETF in particular has become the center of this debate: the Schwab US Dividend Equity ETF, better known as SCHD. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. For years, SCHD was considered almost perfect. It offered a solid dividend yield, high-quality companies, and dependable income. Many investors treated it as the backbone of their portfolios. But recently, SCHD has lagged behind. While tech stocks soared and growth ETFs exploded upward, SCHD seemed stuck in place. Over the past year, SCHD's price return has been slightly negative if you ignore dividends. Meanwhile, other ETFs posted double-digit gains. That has caused many investors to wonder, is SCHD broken? Is it outdated? Or is this exactly how it's supposed to behave? Today, we're going to break this down calmly, logically, and without hype. We'll talk about why SCHD has underperformed recently, what it actually offers, how it compares to alternatives like VYM and JEPI, and most importantly, whether it still deserves a place in a long-term income portfolio. By the end of this video, you'll have a much clearer understanding of whether SCHD is a mistake, or whether selling it now could be the real mistake. So let's begin. Before we judge any investment, we need to understand its purpose. SCHD is not designed to be a growth rocket. It's not trying to chase the hottest trends or dominate bull markets. Instead, SCHD focuses on companies with strong fundamentals, consistent cash flow, and a history of paying and growing dividends. This ETF screens for profitability, balance sheet strength, and dividend sustainability. In simple terms, SCHD prefers boring but reliable businesses over exciting but unpredictable ones. That means companies that sell essential products, companies that generate steady earnings even when the economy slows, companies that can keep paying shareholders through good times and bad. Because of that design, SCHD tends to shine during periods of uncertainty or market stress, and lag during speculative rallies. And that brings us to the last year. Over the past year, the stock market rally has been extremely narrow. A small group of technology and growth stocks carried the entire market higher. Artificial intelligence, semiconductors, cloud computing, and mega-cap tech names dominated headlines and returns. SCHD simply does not have much exposure to those areas. Its portfolio leans heavily towards sectors like energy, consumer staples, healthcare, and other defensive industries. These sectors don't explode upward during speculative rallies, but they also don't collapse as easily during downturns. Because of this, SCHD missed the tech surge almost entirely. As a result, its price performance over the last year appears disappointing at first glance. If you only look at share price movement, SCHD slightly declined. It only turns positive when you factor in the dividends paid to investors. For people who expected strong upside in a roaring market, that feels unacceptable. But here's the critical question most investors forget to ask. Was SCHD ever meant to outperform during a tech-driven rally? The honest answer is no. One of SCHD's biggest strengths is its dividend yield. It currently offers a yield close to 4%, which is significantly higher than many broad market ETFs. That income doesn't come from risky companies or unstable cash flows. It comes from businesses that generate reliable profits and return a portion of those profits to shareholders year after year. When you look under the hood, you'll notice that SCHD's largest sector allocation is energy. Nearly 1/5 of the portfolio is tied to energy companies. These businesses often produce strong cash flows and pay generous dividends, but they don't always participate in growth frenzies. Consumer defensive companies make up another large portion of the fund. These are businesses that sell everyday necessities: food, beverages, household products. People don't stop buying these things during recessions, which is why these stocks are considered defensive. Healthcare is another major allocation. Healthcare companies tend to be resilient, stable, and profitable over long periods, even when the economy struggles. SCHD's largest individual holding is a well-established pharmaceutical company, not a flashy tech giant. That tells you everything you need to know about its philosophy. This structure provides downside protection, but it limits upside during speculative rallies. Many investors look at another dividend ETF and ask why they shouldn't switch. One of the most common comparisons is with Vanguard's high dividend ETF, VYM. VYM has performed significantly better over the past year in terms of price appreciation. It also holds dividend-paying stocks, but its composition is very different. VYM has much higher exposure to financials and technology. Its largest holding is a major semiconductor and infrastructure company that benefited massively from the AI boom. That single difference explains much of the performance gap. Technology and financial stocks tend to do well when markets are optimistic and liquidity is abundant, but they also carry higher downside risk when conditions reverse. VYM's dividend yield is noticeably lower than SCHD's. So while you get more price growth during rallies, you sacrifice income stability. In other words, VYM leans more toward growth with income, while SCHD leans more toward income with stability. Neither approach is objectively better. They serve different purposes. Here's where many investors make a costly mistake. They look at recent performance, feel disappointed, and decide to abandon SCHD at precisely the wrong time. After a long tech rally when valuations are elevated and risk is increasing. Chasing performance often means buying high and selling low. SCHD tends to underperform during euphoric markets and outperform during difficult ones. That means the moment it looks unattractive is often the moment it becomes most valuable. If the market experiences a slowdown, correction, or recession, SCHD's defensive structure can suddenly become an advantage rather than a weakness. That doesn't mean you should never adjust your portfolio. It simply means you shouldn't judge a long-term income ETF by short-term price movement. Another trend drawing massive attention is covered call ETFs. Funds like JEPI promise high income, sometimes even double-digit yields, by selling options on popular indices. During stable or mildly bullish markets, these strategies can look amazing. But there's a trade-off. Covered call strategies cap upside while still exposing investors to downside. When markets fall sharply, these funds can lose value quickly, and they may struggle to recover during rebounds because their upside is limited. JEPI, for example, has not fully recovered to previous highs after recent market volatility. That doesn't mean JEPI is bad. It simply means it plays a very different role than SCHD. SCHD doesn't rely on complex option strategies. Its income comes from real business profits, not financial engineering. That difference matters, especially during unpredictable markets. If you zoom out and look beyond short-term charts, SCHD's track record becomes far more impressive. When dividends are reinvested, SCHD has historically outperformed many competing dividend ETFs over long periods. It has delivered strong total returns with lower volatility. The key phrase here is with dividends reinvested. Many investors forget that income investing is not about watching daily price movements. It's about accumulating shares, growing income, and compounding over decades. When you reinvest SCHD's dividends, you buy more shares during downturns and benefit disproportionately when markets stabilize. That compounding effect is powerful, but invisible in short-term charts. This brings us to a much bigger issue. Most people dramatically underestimate how much they need for retirement. At the same time, they overestimate how prepared they are. Data consistently shows that investors who focus on consistent investing habits rather than chasing returns end up with significantly higher savings over time. It's not about finding the perfect ETF. It's about sticking with a strategy that matches your goals and risk tolerance. For income-focused investors, SCHD remains a strong foundation. It may not excite you during bull markets, but it's designed to support you during the periods that matter most. So, is SCHD perfect? No. Is it broken? Absolutely not. SCHD is doing exactly what it was designed to do. Provide reliable income, prioritize quality, and reduce downside risk. If your goal is short-term growth, SCHD may disappoint you. But if your goal is long-term income, stability, and compounding, it still deserves respect. You don't have to choose only one ETF. Many investors combine SCHD with growth-oriented funds to balance income and upside. But completely abandoning SCHD because it lagged during a tech-driven rally may turn out to be a mistake you regret later. SCHD has underperformed recently because it avoids high-growth tech stocks. Its portfolio emphasizes stability, income, and defensive sectors. Short-term price weakness doesn't reflect long-term total return potential. Chasing performance often increases risk at the wrong time. For long-term income investors, SCHD remains a valuable core holding. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.